Okay. So welcome to our February Lunch and Learn. We're excited that everybody is here and look forward to a presentation. So today we have Conor Clark with us, and we're going to go through a few housekeeping things first, and then we'll get started. So first off, there's quite a few things on our calendar that are coming up, events. Our next Lunch and Learn, which is really exciting, just wanted to highlight that for a moment, is celebrating March Procurement Month. And we're actually having the National Radio NIGP folks come. Victor helps with that effort, but we're really excited that they're going to be coming and telling us all about that. And we also have other learning opportunities during the next few months, as you can see as well on the calendar, and these are also on our website. So today I'm going to hand it over to Reagan for just a moment. We have breaking news that our new website was released today, and she's going to be explaining a little bit about that. So I'm going to hand it over to you, Reagan.
Thank you, Rena. Yeah, just a quick update for all of you. If you haven't already migrated over to our new website, if you just go to the old website URL, it will take you directly into our new website at Club Express. So that is up and running. If you have any issues or run into any complications, please reach out to Maya, myself, or Megan Waltari, and we can help you. As Rena just mentioned about the education, there is a couple of ways that you can search for our events that we have coming up. One of them is in the blue ribbon, the navy, the dark blue, like you see here. There is a education and events drop-down menu, and then you can find the events calendar there. Or about a quarter way down our page, there's also an events calendar button there too that you can click, and it'll open up the calendar, and all of our events are displayed there. So, look around our website, reach out if you have any questions or if you have any issues. We hope it's easier for you to navigate. Thank you.
Thank you, Reagan. Really appreciate that. So first things we wanted to kind of do this little housekeeping is we would like everybody to mute yourself and enjoy the presentation. And there is also, to get credit, you need to put your participant name as a full name along with your association. And the other thing is that we're also using the chat. So if you guys want to use the chat to ask questions, the chat feature is where we're going to be looking for questions. The next thing is we also have there's a raffle that's going on for Forum 2023, and there will be a contest in relationship to all the people that are turning in their name with their actual, it'll say raffle after your name in the chat box, because then we will be putting you into that raffle. So if you put your name and then raffle after your name in the chat box. And there is exciting news in relationship to that, because we will be giving out an award for that to a lucky winner. The next thing that we have is we have an amazing lunch and learn for you today. And we have Conor Clark with us from OMCI, and he is the vice president of this company. And he's going to be talking with us with lots of years of experience on learning working with project teams across the country. He applies his experience with economic analysis and customized cost estimating solutions in his presentation. So I want to introduce Conor to you and gonna let him take it away at this time with his presentation. The one thing real quick is at the end, we will be going through the questions. So he's going to go through his presentation first completely, and then we will have time for questions at the end. So Conor, welcome, and we'll let you take over.
Thank you, Rena, and good afternoon, everybody, or morning if you happen to be in Hawaii, I suppose. It's a real pleasure to be here. As she said, my name is Conor Clark. I'm a vice president with OCMI. And without any further ado, let's go ahead and jump in. What we wanted to do today, when we looked at potential topics for presenting to you folks, was try to give you something that would be germane to your day-to-day job, and give you some information that hopefully will assist you in helping to make decisions on behalf of the facilities and the organizations that you so crucially support. So without any further ado, there it is. Thank you, sir. So do a quick rundown on the agenda for today. We're going to go through a little bit about me, just so you guys know that that I didn't just stumble in off the street and manage to talk polysyllabically. I've got a couple of qualifications at this, one or two. Then we're going to go into the state of the market, talk a bit about where we're seeing specifically Washington and Western Washington economics tracking over the next 12, 16, 24 months, but also a little bit nationally too. So we'll jump into that. Then we're going to talk a little bit about sources that I would recommend to all of you if you have an interest in trying to stay up to date on these types of issues or items yourselves. And then we'll end with some tips for procurement professionals. We wanted to pull it all together and give you guys a couple of action items that we thought would be directly applicable to your sort of day in, day out jobs. So with that, let's go ahead and jump into the introduction. If we could go one more card, there we go. So as I said, my name is Conor Clark. I am a vice president over at OCMI. I have 15 years of cost management and finance experience. I actually came from the financial world. I grew up in construction. My father was a general contractor. But when I got out of college, I wanted to go work on Wall Street. So I worked as a financial analyst and investment banker for about 2.5 years before I got out of that and segued over to this. I am one of the resident economists for OCMI. Myself and one other person oversee that department. And I'm responsible for parametric analysis of pricing trends across 65 different major metropolitan areas across the country, which are where we maintain price books for. So in addition to that, I oversee cost estimating operations for most of the offices up and down the West Coast. And in my career, I've overseen a pretty diverse array of projects ranging from under $250,000 to over $1 billion. My specialties are centered in civic and healthcare estimating or cost estimating, with civic to include non-specific governmental construction, offices, and things of that nature, as well as education. Let's go ahead and go to the next card. Thank you. So the state of the market. It's been a long couple years, hasn't it? The last 2 years have been a very interesting time to be in our business. I can't remember off the top of my head who said this, but somebody said, "May you live in interesting times." And thankfully, none of the people that are attending this meeting will have any cause to lament the lack of that when it's all said and done. When we look at market analysis and performing market analysis, we have several different key factors that we center our analysis and our attention on. The first one is macro and microeconomic conditions. When I say macroeconomic conditions, I mean economic conditions that are seen across. I'm sorry, could we go back one more card? Thank you. Macroeconomic conditions are conditions that are noticed across the entirety of our economic picture. So the entire United States, indeed even potentially the entire world. Microeconomic analysis is going to be more restricted to individual economies, so state, city, local, those types of things. Labor and material availability is incredibly important component to what we're going to be discussing, and we'll be diving into that pretty significantly. And we'll also be spending some time talking about energy costs. Energy costs are an incredibly important component, both to general construction costs and to material pricing. And then lastly, we're going to spend a fair amount of time talking about the overall level of capable and interested competition. Okay, perfect. If we could go to the next one. Sorry, I needed an in the box. So macro market analysis. 2022 was, for lack of a better expression, the year when the chickens finally came home to roost. Somewhere between 10 to 14 years of unprecedentedly aggressive federal monetary policy in terms of quantitative easing and bond buying, in terms of low interest rates, combined with almost previously never seen amount of direct assistance flowing to the general public because of COVID. And what that combined to do is essentially to manifest about 5 to 7 years worth of inflation all at once. The other side effect of that is we don't really have a model for what happens when you pump billions and billions and billions of dollars into the economy in a very short period of time, in terms of where the economy is likely to come to rest again when things come back to normal, if you will. I hope I'm not going to break anybody's heart here, but nobody who's in my business has a crystal ball or is psychic or can make the economy do what we want. If we did, we'd probably still be, I'd probably still be trading for a hedge fund, or at the very least, we would charge more for our services. We rely very much on predictive past data in order to inform the future. And so when economists and people like myself get into a scenario where we're in unprecedented economic times, we're in our uncharted territory, it becomes a lot more difficult to say where we think things are actually going to come to sit once we get back in quote unquote normal territory. That being said, it is our analysis that the majority of the reductions in the economy have happened at this point. Real worker wages, despite having a significant amount of expansion over the last 2 years, are still trailing the consumer price index by a fairly healthy margin. And that is creating a perception that although wages are up, that they essentially haven't risen at all, because nobody's actually seeing any additional take-home money in their paycheck at the end of the day. Our supply chain challenges have been, I don't think I have to tell anybody here, very, very severe over the last 2 years. But we anticipate that the worst of those spikes are behind us and that things are likely to continue to ameliorate. As we move further into 2023, we're also going to be concerned about energy costs, mostly tied in with geopolitical conflicts in Europe. I'm speaking of the conflict in Ukraine. Let's go to the next card. So let's talk a little about current construction spending. Total non-residential construction spending has more than rebounded since the pre-pandemic numbers. So we had a fairly significant dip over the course of the pandemic and then have had to fight our way back out of it. But we have more than recovered all of that lost volume over the intervening period. Annualized rates of construction put in place reached a new high in November at 1.8 billion for that month nationally. Which aligns fairly well with the Architectural Billing Index expectations from 9 to 12 months previously. We'll be talking a little bit more about the ABI in a few minutes. Looking forward, we're expecting private side construction to continue to see small reductions over the course of 2023, while we anticipate public construction continuing to uptick over the same period. Let's go ahead and go to the next card. All right, the Architectural Billing Index. The ABI is a number that is published it was contributed to by all kinds of different architects and engineers throughout the country to the AIA, and the AIA aggregates that and puts out what they call the ABI, or the Architectural Billings Index. The ABI is a numerical expression of how much work designers are seeing at any given time. Because design serves as a necessary precursor to construction, people who are in my business tend to use the ABI as a shorthand predictor for where we see work volume going in about 9 to 12 months. That is, generally speaking, the standard interval expectation for when a project is in design to when it's going to be coming out for bid. When you look at the ABI, anything in excess of 50 is considered to be an expansion, and anything below 50 is considered to be in retraction or recession. And what you'll see now is that we are in a situation where we are below 50, but not by much. It's worth noting that with the amount of reductions in private side construction and shelved residential construction that we saw over the second half of 2022, and a lot of other circumstances, we would expect those numbers to be lower. They have largely sustained where they are because of the extreme amount of public construction that's been coming down the line, which we'll talk about in a little bit. But looking forward, we anticipate the ABI to essentially remain right around current levels or slightly uptick. We saw a slight uptick over the changeover from 2022 to 2023. You'll see that December's readings were in the 46s. The current readings are in the 47s, which not a huge uptick, but definitely worth noting. And we anticipate that this number will stay right around between about 49 and 51 over the course of 2023 and indeed into 2024. A couple other macro market indicators and just a quick little breakdown for the ABI. I'm not sure exactly for the location for everybody on this call, but I saw at least one person who was calling in from Kansas. So we wanted to throw more than just the West Coast numbers up there. ABI is calculated for 4 different regions across the country. You have the West, the South, the Midwest, and the Northeast. Of these 4 areas, the only one that is continuing to see reasonably robust growth across the board is in the South, where the lower cost of living and the lower cost of home ownership and home acquisition is serving to continue demand for single-family residential housing at an outsized rate relative to the rest of the country. Looking forward for projected construction spending more broadly, as I'd said, we are anticipating residential construction and private side construction across the board to include office space, warehouse space, technology, to downtick over the course of this year and into next year. But we anticipate that this will be more than offset by continued public construction. The CARES Act has created a very, very significant amount of capital in the marketplace that is not normally present. The COVID relief bills, in most cases, gave more than 3x the shortfall for most state and local budgetary shortfall problems. So if they were, short $50 million, they probably got $150 million in federal money. And what that has resulted in is an extreme amount of projects coming down off shelves. Projects that had been dismissed as being too expensive or just not feasible for whatever reason are all being considered now because of that particular dynamic. When you combine that extreme spike in publicly available money with historically low interest rates and supply chain disruption that came from as a result of COVID, it becomes a little bit more clear why we've had so many problems with accurately pacing and satisfying construction demand over the last 18 months. So let's talk a little bit about material pricing. There are a lot of different roles or a lot of different things that affect material pricing and that have been pushing material prices sort of slowly and inexorably higher over the last 24 months. But shipping costs have been one of the larger, I guess I would say, single drivers of those material price fluctuations. Shipping is obviously an incredibly important part of the modern supply chain. Most things, at least in their base materials, are not produced domestically and have to be brought in from outside the United States. And when we had to go into COVID lockdowns, we saw the effects of an aging infrastructure system. The total tonnage of shipping in the water was nowhere near enough to satisfy short-term demand spikes, much less long-term demand spikes. And so when we had a situation where everybody came back online and restarted projects at the same time, and then combined that with new project starts that were necessitated by COVID, the replacement of air handlers or, contactless opening systems for facilities or what have you, there were nowhere near enough ships, total tonnage of shipping, in order to satisfy demand. And so we've had to rebuild rebuild shipping capacity over the last 2 years to a level that's sufficient to satisfy demand. The chart that you'll see is the Drewry World Container Index, which is a tracker for the cost of shipping a 40-foot container from China to the west coast of the United States. And what you're seeing there is an index that actually starts in February of 2022. The part of the story that doesn't tell you is that in December of 2019, the Drewry World Container Index was sitting at $2,000 a container. Over the course of about the first 14 months of the pandemic, the cost of shipping a 40-foot container went from $2,000 to over $10,000 per container. That was a very, very significant up spike. The interesting thing is we have now actually downticked past the pre-pandemic number and are down at around $19.50 per container. And this is because of capitalism has done what capitalism does so well, which is respond to opportunities for profit. There has been an explosion of shipping container or of shipping tonnage over the last 18 to 24 months with new boats hitting the water. And now that we're starting to see volume reductions in terms of total construction, there's actually a pretty good bargain to be had in shipping materials from outside the country to inside the country. More broadly speaking, pandemic material pricing was affected by demand. The most significant material price spikes that we saw over the course of the pandemic were concentrated in metals, woods and plastics, and MEP equipment. And of those, the most significant ones were seen in metals and MEP. Metals was driven by actually a very, very particular condition. Well, two, if we're going to be entirely honest. One is increased Chinese consumption. The Chinese restarted their non-ferrous scrap buying program at the beginning of the Biden administration, which increases domestic steel rates here because we actually don't produce much actual raw steel in the United States anymore. Most of our steel that we use for construction is resmelted and reformed scrap iron. So when scrap iron prices are commanded higher by Chinese consumption, it becomes more expensive domestically to produce steel. The other problem with steel, being completely candid, I'm sure this won't surprise anybody who's on this call and is situated in the Northwest, Amazon was buying about a third of the domestic steel market directly off the line for the better part of the last 3 years. They suspended that program about 4 months into 2022, which is when we started to see pricing become more reasonable. But for the 24 months that were preceding that, Amazon was essentially buying and sticking into a warehouse, actually in both ways that could be interpreted. They were buying and storing and then using to build new warehouse space. So as that is downticked, as Amazon has downgraded their expected, projected growth in demand, they have released their hold on the steel market, and we're starting to see a little bit more freedom in that particular material subsector. MEP equipment is a more broad-based problem and is not one that will be solved as easily. We're going to talk a little bit about what we see coming up at us over the next 24 months or so from a material price premium perspective, but MEP equipment is still something that we are anticipating will be very expensive in the coming years. Excuse me. A lot of that is being driven by a couple of different things. One is materials. Copper is becoming much more difficult to extract and refine and transport. The other problem is that these particular pieces of equipment, their production is very decentralized. Materials are extracted in one part of the world, they're shipped to another part of the world where they're assembled into basic components, and then they're shipped into another part of the world where they're assembled into final components, and then they're shipped to the consumer. There are a lot of different steps at play with MEP, and those particular items are translating to very, very long continued lead times and price premiums, which we'll talk about in a little bit. Energy costs have also been a big factor in some of the price premiums that we've seen, especially over the course of 2022, less so prior to that. The problem with energy costs is essentially threefold. One, energy costs are the most pervasive part of a material price because you actually end up paying for a spike in material or in energy, about 5 or 6 times before you finish paying for that material. And the reason is because energy is used to extract the raw materials that are used to actually create the product. That's then used to transport those raw materials. It is used to manufacture or refine those raw materials into the finished product, transport the finished product to the construction site, and then is used to actually put that product in place on the construction site. Consequently, a material price spike in the energy subcategories will be felt by construction factors of production vastly more so than most others, because they're getting inserted at so many different times throughout the process. The other problem with energy is that, one, we from the perspective of light sweet crude, which is what is used to be refined into gasoline that we actually run vehicles on, we don't have much of a say in the production volume of it. OPEC is essentially in charge of the production of petroleum or petroleum-based products in the light sweet crude categories. And OPEC has decided over the last 12 months that come hell or high water, they will have $100 a barrel oil. That's the decision that they have made. And quite matter of factly, until they decide differently, there's really not a lot that the other non-OPEC countries can do in order to affect that. The other problem with energy is related to Russia and the Ukraine. If you exclude gasoline-based energy costs and you focus on the other ways that energy is produced, primarily you're looking at coal-based energy, and natural gas. And those are both areas where the United States has an exceedingly rich stock in terms of our ability to produce and sell. I don't remember who said this, but I was on a call with the AGC a couple of months ago, and he said that we are the Saudi Arabia of coal. Coal is what we've got a lot of. The problem is that coal is also what the Ukraine and Russia have a lot of. And in the absence of them being able to ship that to Europe, Europe is having to come to us to offset the difference. That's obviously raising domestic energy costs, but it also raises other costs too. So the more coal is absorbed by Europe, the less coal is available domestically. In addition to coal being used to generate domestic power, it also goes into the production of items like concrete at a rate of 2 to 1. If you want to produce 1 cubic yard of concrete, you need 2 cubic yards of coal ash in order to do so. So as we see upticks in energy consumption owing to our shipping energy, the ability to essentially produce energy out of the country to other NATO partners, we are increasing both our own domestic costs for production of energy and our domestic costs to produce other materials. Let's talk, let's go get into some predictions here. This is, despite my disclaimer about crystal balls, this is where I contravene that entirely. Continued competition for effective labor is going to force above average rises in commanded wages, essentially over the foreseeable future. We're going to talk a little bit about labor here in a moment, but although we anticipate most material pricing issues ameliorating over the next 12 to 24 months, we do not see that same opportunity in the labor markets and are currently projecting, we are currently projecting shortfall in qualified construction labor over an infinite time frame. I'll get a little bit more into that in a minute here. While interest rate hikes have been substantial over the course of 2022, we do not expect that those are likely to continue over the course of 2023. Now, this should not be construed as me saying I don't expect any interest rate hikes. I do. I expect those rate hikes to be significantly lower than they have been over the course of the last year. The current commercial interest rate on a 30-year fixed loan is about 6.65%. Which is about 1.5% above the long-term commercial average interest rate. That's not a problem. It's actually arguably a good thing. But now that we have achieved parity or indeed are above parity with long-term interest rates, we expect the Fed to start to take a little bit more of a circumspect position when it comes to future interest rate rises, because over ballparking that particular number could have a highly deleterious effect on the rest of the economy. As interest rates have risen, private side construction demand has decreased, but public side construction demand is picking up the slack. These are a phenomenon that we expect to continue. There is an interesting thing that happens with private side construction, though, where if the cost of construction falls enough, then we tend to see a very, very fast crowding back into the marketplace. Private side producers like to produce when they feel that they can do so at a profit. So let's talk a little bit about micro, and I apologize to anybody who's not located in the sort of greater Seattle, Western Washington area, but I'm going to talk a little bit about micro market conditions here. But if you have questions about micro market conditions in your particular region, please feel free to put them in the chat box. And to the best of my ability, I'd be more than happy to speak to them later. Currently, Seattle has the fastest cooling housing market in the United States. Now, that's due mostly, I would say almost entirely, to the fact that it also had the hottest housing market in the United States for a long time. I believe it was about 4 or 5 consecutive years. But as of right now, we saw the first decline in average pricing for both single family homes and condominiums from 2022 to 2023 that we've seen in 10 years, which is a pretty remarkable run. Snohomish County markets remain more competitive for buyers and are edging out King County. This is based, in our assessment, on the continuation of the trends that we saw over the course of COVID, with people trying to move a little bit outside the downtown core, but still retain a certain level of access and ability to be in the city if they need to in any given day for work purposes. Residential construction tapered down in both MSAs over the second half of 2022 as private side producers shelved projects due to a lack of profitability. The extreme rate of starts over the last 18 months across multiple sectors has created all-time highs for worker absorption in both King and Snohomish County. We've never really been, in terms of the modern economy, in a situation where we had to completely restart all of the projects that had been started, let's say within the last 18 months before a given date, in this case, the COVID shutdown date, and then also start all of the new projects that had been thought of over the intervening period. That created an extreme amount of absorption in the trades, and we're not well set up in terms of we're already underwater relative to the total number of tradesmen that we actually need. And so that created extreme imbalances in terms of our ability to staff jobs in the area. We go to the next card. Thank you. So let's drive in a little bit and talk more specifically about labor. Across the economy, across the entirety of Western Washington, King County, Snohomish County, hiring has remained reasonably strong. It has not remained ubiquitously strong. Decreases in certain sectors of employment, notably technology, warehouses, office work, have declined, but those have been more than offset by gains in construction and other subsectors like nursing and education. Overall, what we've seen over the last about 3 years has been a net sideways push. We've gained about 2% of jobs over that period, if you include all the ups and downs and ins and outs, which translates to about 67,000 more jobs than we had pre-pandemic. Bright spots for our area is construction and associated professional disciplines are continuing to expand. 7% year-over-year growth statewide is a pretty encouraging metric for a fairly developed economy with a fairly strong construction workforce that was existing. King County closed 2022 with 140,000 full-time workers, which represents both a high for them in terms of closing out the year, but is actually a slight downtick from the real all-time high, which they'd reached earlier in the summer of about 144,000 full-time workers. Snohomish County, likewise, is seeing an all-time high currently for total construction employment, and is sitting at about 26,000 full-time workers working here. And both of these areas are expected to see continued construction demand growth in a fairly consistent manner over the next 5 to 10 years. So let's talk a little bit about the elephant in the room, and this is where I want to sort of concentrate the remainder of the presentation, because if there's anywhere that I feel like we have you know, some ground to make up and some things that we all as professionals in fields related to construction need to be aware of, it's in construction labor. Construction labor market in the United States is currently fairly underwater. We have about 80,000 more open positions nationally for construction, qualified construction workers than we are able to fill. This is due to a number of different issues. The biggest one is that construction workforce is aging. The average master craftsman, especially in the technically involved or supervisory trades, is between 68 and 72 years old. And it's actually getting much, much closer to about 72 now than 68. The other part that people should be aware of is that the millennials have gone into the trades at about 30% the rate of their predecessor generations. This has conspired to create a situation where we have folks that are retiring every day, and we just do not have the people coming up behind them. What's serving to offset or divert people from going into the construction trades? One of the biggest ones is the rise of the warehouse and logistics job. You know, 30, 40 years ago, if you wanted to get a good job, but you didn't necessarily want to go and get a college degree somewhere, your options were somewhat limited. You were probably going to end up going either into civil service, police, firefighter, somewhere along those lines, or you were going to end up working in construction. This is not the case anymore. Our economy offers a lot of potential employment opportunities where people can have a reasonably high standard of living and a reasonably high pay standard, benefits and all of those things, while not having to serve a 5 to 7 year apprenticeship in order to get there. And that has had a very, very significant effect on the construction market's ability to attract labor. When you combine that with the fact that the pay wages, the commanded wages of construction labor, as I mentioned earlier, have fallen relative to the cost of living pretty consistently from about 1975 to now, it becomes fairly easy to see why construction is less interesting to the current generation. We go to the next card. Looking forward, it is our assessment that comprehensive efforts by a blend of local government and private sector leaders, as well as educators and other, significant components of the local economy, will be required in order to construct a pipeline that is capable of delivering qualified workers at the levels that we believe will be needed over the foreseeable future. We are seeing upticks in construction, in the attraction of construction labor. The last year has been a good year for enticing new folks into the industry, but we are still not pulling enough people in at a rate that will allow us to equalize with the rate at which we are losing the more senior counterparts. So it is our estimation that, and we've seen this work in a number of different areas where we're estimating with public clients or private side clients where they're actually working to construct pipelines with their local association of general contractors, their local unions, and local high schools. They're doing industry days to go in and show kids, you know, hey, you can make a darn good wage as a sheet metal welder or as an electrician, and you don't have to spend $100 grand on college in order to do it. But those are the areas that we're seeing on average that are having a lot more success in being able to replace workers as they retire. So let's pull it all together and do a big picture here. We anticipate material price increases continuing the trends that we saw at the end of 2022. So the important thing to understand is that materials are not going to get cheaper. That is not, generally speaking, how capitalism works. What we are expecting is an amelioration in the rate of increase. So if the average increase over the course of, let's say, 2021 to 2023 was 25%, we expect that returning back closer to 7%, 6% this year. So things will still get more expensive. They're just going to return to much closer to their average levels over the long view. Drops in local private construction volume will not be enough to offset labor shortfalls based on current projections. And as such, we anticipate labor being a problematic thing on most projects, especially projects with any kind of significant technical involvement for the foreseeable future. This will result in higher construction costs than are typically seen in both recessionary and balanced economic environments. Normally, when we get to the part of the economic cycle that we're entering, it's a great time for owners. It's the time for them to start making up some of the ground that they've lost in terms of being able to get good value for money on projects during expansionary environment periods. We don't anticipate this being as much of the scenario this time, simply because there are just too few people to handle the work. And as such, we anticipate the cost of construction remaining higher than it normally would under similar economic periods in the past. So we'll do a couple of quick predictions here. Looking forward, we expect to see a reduction in starts across multi and single family housing for at least the first half of this year, along with office, warehouse, and tech sector building construction. It is unclear whether or not those trends might just start to reverse themselves late in the year, Q4, because what would be required would be a fairly stiff rate of reduction in terms of overall construction costs. And I've not yet seen a compelling argument that that math is likely to occur this year. As of right now, we anticipate those sectors starting to restart a little bit as we get into 2024. The greater Seattle area will still have multiple large projects that are going to serve as to provide essentially a minimum base of construction labor demand over the next 2 to 5 years. We'll talk about those in the next card. In total, the greater metropolitan Seattle area's largest 25 projects alone total more than $27 billion in construction value. And those are all going to be delivered sometime between today's date and I believe about 2025. That figure illustrates that the Seattle market has changed very significantly over the last 10 to 15 years. This is not a regional construction market anymore. This is a tier one, arguably internationally significant metropolitan statistical area, or MSA. And as such, we are not going to be essentially prone to quite as much swing as smaller markets see. The depth of the business commitment to Seattle, the depth of the different sector spread in Seattle is going to dictate a level of work that historically has been more seen in areas like Chicago, New York, Los Angeles, San Francisco. We have hit a point at which our demand levels will stay higher than they would have 15, 20 years ago. So this is just a quick list of different projects that are going to serve to compete for construction dollars in the area. We were lucky enough to be asked here because I have the pleasure of serving as an owner's representative for the Port of Everett. So we wanted to concentrate at least a little bit on some flat work there. So you'll see a fair amount. There's about $1.3 billion in waterfront work going on in Seattle alone. If you add in the other sound transit expansions, it climbs very, very quickly. In addition to that, we have about 12 or 15 billion in significant vertical construction projects that are currently ongoing, all of which will be wrapping up sometime between now and about 2026. And tips for procurement professionals. And please, guys, feel free to disregard these if you feel that they're not useful. We wanted to try to give you a little bit here, but I will be honest with you, I've not been a procurement professional in my career, so it's entirely possible that I have missed some part of your process that would make some of these things not possible. I would first recommend assuming an active role in the development of projects. Building a strong relationship with local suppliers of labor, with building and trade groups, with local designers and those types of things has a significant effect on whether or not you'll be able to achieve goals and achieve goals at a price point that is within shouting distance of what you want to, based almost entirely on the development of relationships. Anything that can be done to incorporate potential bidders and material suppliers into the process early is going to pay significant dividends later on. I alluded to this earlier, but I'll give you an example. I'm working on a project right now that is an electrical utility replacement project. We have to replace a bunch of panels and transformers and some other items. I just got a quote in from the material supplier. I believe it was late last week. They've quoted us 103 weeks to fabricate and deliver the panels and transformers that will be required for that project. So that's just a shade over or under 2 years just for the material production and delivery. The sooner processes like that can be started, the better off everybody's going to be in these projects. Plan on having things like project walks, industry days, anything that you can do to create a better level of understanding between your contracting community and the project is going to be good for you guys. When contractors look at projects, uncertainty to them equals risk. The more you can eliminate uncertainty and the more ability you can give them to bid based on knowns, the much higher likely the chances are that you're going to get a strong bidder turnout on your projects. And the most important thing that I can drive home, if anything, is that controlling for all other variables. If you ask me what's the one single thing that's most important to try to do to try to get good value for money on a project, I would tell you the most important single thing is to get as many bids as you can on a project. It's been shown time and time again that bidder interests, overall bidder levels on projects, is actually your single best predictor of the value for money that you will get on them. The Army Corps of Engineers did a study in the late 90s where they found that for every bidder under 5 that they got on a project, they found that the cost of that project rose by between 2 to 3%, and that rate compounded as they lost bidders. So you'd see a 3% premium at 4, but you might see an 8% premium at 3. So anything that you can do to encourage the local contracting market to be paying attention to your projects and to make them more likely to bid them is going to yield incredibly significant results. And a couple quick things. I would very much recommend tracking your bid results. As owners, you guys have the gold standard data being provided to you. Really recommend tracking those. My team and I spend, hours, days calling around to people trying to get the data that they just provide to you guys by way of bids. So I would definitely recommend tracking those. Bear in mind in all things that it's the singer, not the song. The conditions in which a project will be constructed or undertaken have as much or more of an effect on the cost of that project as does the actual nature of the project itself. Constructing, the 10-second example is constructing a shed in an open field costs about half to a third of what it would cost me to construct that same shed on a field, but inside the boundaries of a correctional facility. So there's a lot of things that you have to bear in mind, but the situation is as or more important than the actual scope. And then, as I said before, greatest predictor of value for money is the number of bids that you receive on a project. So with that, what I'd like to go ahead and do is move into QA. We're a little short on time. I'd be more than happy to shoot out a quick one sheet for references. If anybody would like to go and spearfish any of this data themselves, I can send you the locations for the different things that we use that are open or public source. But I don't want to waste your time with that. I want to make sure that we get some time to answer questions.
Yeah, Connor. So we have a few questions that have been submitted. So the first one is thoughts on how the new federal guidelines regarding construction material to be 100% American made will impact pricing and availability for those using or utilizing the federal funds for construction projects.
Sure. It's going to vary. So certain individual federal agencies already had Buy American provisions inserted into their requirements. Like one really good example would be the VA. The VA has been required to, insofar as it's possible, utilize Buy American for the last 15 or 20 years. The thing to bear in mind is that if, I believe if it's 25%, you'd have to check the individual number, but if that Buy American Act and those provisions are going to raise the cost of the project by, I believe, more than 25%, you can get a waiver. The federal government is crazy, but they're not stupid, and they don't want to pay any more money for this than they absolutely have to. If you cannot get those waivers, and this was not a condition that you had previously seen on these projects, the price rise will be significant. I would expect, rough ballpark, probably somewhere in about the 25 to 30% premium range relative to the material price that you were carrying. But the bigger problem is that if it has to be American made, then the production cycle is of a much bigger question at that point. We're trying to reshore the production of things like chips and semiconductors and that kind of stuff. But until, Foxconn's building, I think they've got about 3 million square feet of active production space being built right now. But until those facilities come online, the bigger implication for a Buy American provision would be that your project's likely to sit for 12 to 18 months while you wait for pieces to actually be delivered.
Okay, great. Thank you. So the next question is, what is worker absorption that you referenced when you were talking about the Seattle residential construction?
Okay, so what I'm talking about there is essentially the rate of construction workers that are working, right? So if we're in a situation where we've got more people working currently than we ever have before doing construction, local absorption of construction labor is very high. Most of that market is already off working on projects. And construction labor functions very much in a semi-short-term sense. If they have a job for today and they have a job for tomorrow, they're not going to be quite as concerned about looking further out than that. And again, because the expected bidder turnout and the expected level of interest from contractors is our single biggest predictor of value for money, we look at situations where worker absorption is very high as being counter to the interests of owners most times. Does that answer the question? It might not.
I think it does. Yes, she's saying yes.
Okay.
Thank you.
Got it.
Okay. And then the next one is, any advice on how smaller jurisdictions can compete with larger projects going on?
Lump projects together. The best advice that I can give you is that rather than putting out, 3 $650,000 projects, I would recommend putting out one $1.9 million project, right? The more meat on the bone you can give to contractors, the more interest you're going to get from contractors. The other thing that I would say is, make you guys the easy ones to work with. Some municipalities, larger municipalities or larger metropolitan areas, essentially function as small offsets of the federal government, which is to say that they can be a little bit difficult to do business with, right? And to get the answers that you need and those sorts of things. smaller areas don't suffer from those same realities, right? Oftentimes people are in their jobs longer. They know each other well. They know their counterparts in other departments. So if you can make it easier to do business with you guys, that will also drive up a lot of interest.
Okay, the next question, what or who is a good resource could private market information related to Kansas?
Oh, well, that is a very broad question. What I'd like to potentially do is maybe connect with that person one-on-one and find out what information it is that they're specifically looking at or looking for, and see how I might be able to assist. I do some work in the middle of the country. I actually did a bunch of projects for the University of Nebraska last year, and I'm working on some federal projects in Leavenworth and a few other areas. So I might be able to help, but if I can't, then I'd be more than happy to refer you to some folks that I know that run design concerns and other businesses in the area.
Okay. And I think I got all the questions. If not, if anybody wanted to ask. The other thing is you do have a few more things on your slide deck. If you want to finish that out, we're almost out of time. But
yeah, we could. Sure.
That would be great.
With the oh, hold on. Somebody had a couple of other questions. I had a contractor tell me if your agency is easy to work with, they will also add up to 30% to the cost. Yeah, I wouldn't necessarily commit to 30%, but contractors, as I said, they'll bid every job, but they'll bid the jobs that they want pretty differently than the jobs they don't. Like sometimes when they'll put a bid in and going, well, we're probably not going to get this because we have a 17% profit margin on it. But if we do get it, I'd be more than happy to do it for 17% profit margin. So I wouldn't necessarily commit to any individual number, but the rate of increase can be absolutely significant, yes. Would the lack of labor affect lumping projects together? Yes and no. I mean, generally speaking, the larger the project, the more likely you are to get bidder interest. The more likely you are to get bidder interest, the more likely you are to be able to adequately staff the project. So for me, I would personally want to lump projects together for the simple reason that I know that I have these 3 or 4 different items covered by the same bid team. Having smaller projects means you now have to go out and worry about bidding each of those 3 or 4 jobs individually, and then worrying about whether or not you're going to get a qualified bidder to handle each one of them. So I don't know if that's helpful or not. Is there any hope in the area of construction materials such as, oh, Connie, I'd love to say yes. I really would. No. Sorry. There's a lot of absorption in the MEP subtrades. We have seen a small rollback from some of the price premiums that we saw, I would say late Q1, early Q2 of last year. So we're not quite at that same crazy level, but the fact of the matter is that we've got an infrastructure bill as a country that we're having to pay right now. There's a lot of piping getting replaced. So the materials are in very, very high demand right now. And then a lot of these materials are also the materials that are the extraction of them is becoming more and more difficult. When you add to that pipe fitters, along with, I believe, sheet metal workers and electricians are the 3 that we are in shortest supply of. I wouldn't necessarily anticipate that getting a lot cheaper.
Yeah, so Conor, we really appreciate all this amazing information that you provided. There's a lot.
My pleasure.
And
there is.
Really, thank you for coming.
My pleasure. If anybody has any follow-ups, give me a holler. Happy to help.
Yeah. Did you have something, Maya?
I do. I wanted to let you know that Conor did send me the slides, and so I've uploaded those. If you are a member of WANIGP, you can log into the website. and access those under member, and then document library. There's a lunch and learn folder there. We don't make that public. So if you're a non-member, I'm gonna put my, I'll put my email address in the chat there. If you are not a member, I can email those to you, because I know a lot of people like the slides. And so, but we don't want to make that public for everybody to just download from anywhere. So.